Hi, everyone. This is Rob Roy, and welcome to the Elliott Wave Options U.S. Market Update. As we do each and every week, we show you on your screen the stocks that will be featured in this recording. And as a quick reminder, if there's a particular stock you're interested in, you can go directly to it using the chapters feature in this recording. All right, let's take a look at the market. Holy cow. Take one Friday to go travel, and the whole world seems to fall apart. So let's catch everybody up on what happened. So we had this big down day on last Friday. And that's why we didn't have an update last Friday. So catching you up here. Y'all know what happened. We had the tweet that came out from President Trump about more tariffs, massive tariffs on China, and the market had opened to the upside on Friday. We were trading higher, continuing this melt up, and bam, that came out, and we just pretty much sold into the close. The thing that got real interesting was that there were sell on the close orders on Friday. If I bring the volume up, you can see what I'm talking about here. And that is forced selling. Institutions had to sell. The market fell so far. These margin calls start to go out. By securities regulation, institutions have to raise cash. They may not want to sell, but they have to. And that's where the name forced selling comes from. And so we had the big move to the downside. And then over the weekend, I did post commentary opining on what are the institutions going to do, because we did get a bounce back up on Monday on President Trump's tweet Sunday night that, don't worry about China, everything's going to be fine. So we get this move back up. And so far, the institutions have not put that money back to work, or have they? And I'll answer that question in a few minutes. So we came down, tested the 50-day moving average. Now I've put a new zigzag on the charts here, as you can see. The old zigzag was satisfied all on that same last Friday. We hit the extension target on the C wave, and when a zigzag ends, you retrace the C wave back to the B. All that happened on the same day. That doesn't happen very often. So this is a larger zigzag that I've drawn here. The other zigzag was incorporated within the A wave, so that was a complex A wave, obviously a mono B wave since it happened so directly. And now we have this complex C wave being formed here. If we can break back to the upside, and we are recording this during market hours on Friday, so some of the prices may change slightly into the close, but if we do turn and move back to the upside, which I think is a possibility, and I'll share that with you in a moment as well, the target price would be up here around 690 on the extension of that C wave. As long as we stay above the 50-day moving average, I think it's no harm, no foul. We're going back and forth with all the tariff talk between the U.S. and China. They're talking about, now they're not buying our soybeans, so we're not going to buy their cooking oil. It's all posturing. We all know that. We all realize that something's going to get worked out. It doesn't benefit the U.S. or China to have a protracted trade, quote, war between the two countries. We need each other, basically, is how it works out. So can we get a close above that 10-day moving average is what we'll look at today. And then we go take a look at the VIX. And we did get a spike out of the VIX. Actually, we hit 28 overnight. We've recovered that so far this morning and are rallying a bit. So the after hours spike would have been up in this area around 28. But I'd been talking about what could create this breakout from this descending triangle. And as a reminder, any triangle can break either direction. A descending triangle does not necessarily mean you're going to break to the downside. So the path of least resistance was a break higher. Could it be the Fed disappointing and not cutting in October? Chairman Powell had a conference this week. Seems like both October and December rate cuts are on board. He was actually kind of giddy, feeling pretty good during that conference. And he also said something else, which I'm going to show you again. To answer a couple questions all in one slide here in a moment. So we did get this move up, but what this increased volatility has done, and with this move down in the SPY, has created amazing opportunities. I talked to you a couple weeks ago about a very special presentation that myself and Jeff Beamer are doing. Two guys with over 25 years and putting us together is over 60 years of trading experience, and that's all we do. We're professional traders, and talking about trading for income, not investing. This is not dividends, trading for income. We did the presentation last Wednesday, and by popular demand, people want to see it live. We record it, and if you sign up for it, you can get the recording. It's a free event, but we are going to do it live again this coming Wednesday, October 22nd at 8 p.m. If you registered for the last one and you want to see it again, there were a couple technical glitches, so we're excited about the opportunity to do it again. But if you were already registered for the last one, you can get you're already registered for this one. But if you didn't, now's your opportunity. Sign up for it. It's a great event. We'll talk about how professional money managers always have part of their portfolio in income generating strategies. Yes, we like to trade directionally, but this is what's smart to do if you want to make money over the long-term trading. So sign up and join us this coming Wednesday. And same thing, it'll be a live event, live Q&A. That's why people wanted to do it again. With watching the recording, obviously you don't get an opportunity to ask questions, but you will this coming Wednesday. So again, make sure you sign up for that. All right, so back to the chart of the S&P. I'll see if we can break above this 10-day moving average. Perhaps this has all just been an excuse to come down and test the 50-day moving average, and we turn and move back to the upside. We'll have to wait and see. I'm going to show you a chart of the KRE a little bit later on when we get to stocks of interest. But for now, let's go ahead and move to TLT. And when we look at TLT, you can see that we are moving to the upside here. Remember, if you're newer, TLT is prices on the 20-year. Prices and yields move inversely. So with prices moving up, that means yields and rates are moving down. That's a good thing. But if rates go down across the yield curve, that means we don't get a steepening of the yield curve. A lot of you like to look at the TNX. So the two charts are showing that there's an expectation of rates continuing to go down. I'd mentioned that I'd be really surprised to see this wave 5 hit on the TNX. So the TNX, again, is rates on the 10-year. So rates moving down here. But based on what's occurred the last couple of days, that seems in play now. Rates continuing to go down. Again, it ties in with what we said with TLT, prices going up, yields and rates going down there. But still, it's across the maturities of the yield curve from short to long. We do want to see at some point that yield curve begin to steepen. It's still flat, but the market likes easier money. And we've got a chart here of showing you the SPX and financial conditions, which I think is really telling. I talked about how the Federal Reserve had been withdrawing liquidity. They've been adjusting their balance sheet. And that's what Chairman Powell talked about. He even talked about how they had been shrinking their balance sheet and perhaps they'd gone a little too far and they were going to be looking to adjust that. And there has been a tick back up in liquidity. If you look at the chart, the blue line is basically liquidity in the financial conditions. And you can see that's moving up above where the black line is, which represents the SPX. So if the Fed does start putting liquidity back in, we start going into rate cuts, that's your case for the market potentially going back to the upside. So Chairman Powell, kind of just verified both. The withdrawal of liquidity, that process is over, and the fact that the October and December rate cuts are likely on the table. All right, so let's do and see what all this is doing to the dollar. So let's switch over and take a look at the chart of the dollar. And when you look at the dollar, it's hell hanging in there. We did get a little bit of a break higher with liquidity coming back in and potential for rate cuts. I thought we might bounce up to 100 to that resistance line. We didn't quite make it, but we're still in this Goldilocks channel. I've been calling this, that for the entire year, basically, we've been trading within this range, save a few spikes out there. But for quite some time, this Goldilocks channel is positive for companies with international exposure. We're in a global economy. Most companies do have international exposure. So with the dollar staying in the lower end of the range, but not collapsing, I didn't want to see that. And so far, that didn't happen. I didn't like it when this wave 5 took out the July low, but that was it. It was a short event and back up into Goldilocks land here. So everything's okay on the dollar as we take a look at it from there. Now let's go take a look at the metals. Holy cow. When we look at GLD, you can see that this vertical move, which has gone much further than I thought it would go. It even went further than the AI thought it would go. And if you haven't seen this before, if this is the first time you're viewing us, welcome. This software is from the Hub organization, hubb.com. You can get a copy of it for free. You can get the Elliott Wave labeling for free. They aren't my labels. They're labels from the algorithm that Hub uses directly from the algorithm that Ralph Nelson Elliott himself wrote. You can subscribe to the AI signals if you want, but you don't have to. You can get the actual software and the Elliott Wave signals both for free. But we had this breakout of GLD. We caught that in a trade. Then we had the AI say, oh, we're going to go a little higher, which we did for almost 2 weeks. And then we've had this just unbelievably steep vertical move, getting awfully close. Actually, the metal got above 4,000. GLD may catch up there. We're getting a little bit of a tick down today, but you can see where we closed yesterday. We were way above the 10-day moving average. You know the rule, no security any time frame gets too far from the 10-day moving average, at least not for long. And when things go vertically up, they oftentimes come vertically back down. Is that what's going to happen with GLD? And then we take a look at silver with the metals. And their AI had a target on that's been exceeded as well. Is silver now going to outperform GLD? So silver going to outperform gold? Because going back to the chart of gold, you can see how far we went above the AI target. And if silver is playing catch up, perhaps there's a little more room for silver to run, or maybe all the metals need to take a break. If you're a member of Top Shot, we had a nice trade on uranium. So that whole space, platinum, all the different metals, palladium, they're all doing really well. But we had a trade on uranium and Top Shot. And thank you for your comments. For those of you that signed up, if you haven't signed up for Top Shot, you can do it at ewotrader.com/Top Shot. Basically, I pick from our 4 primary portfolios a trade of the week. And so you get one each week, and it's really a no-brainer to take advantage of it. And we're off to a really amazing start with the weekly alerts that have been sent out from Top Shot. So hopefully you take advantage there as well, as I said. All right, now let's take a look at energy. Man, we nailed this one at ewotrader.com. I actually thought we might finally get a breakout. If you remember, what I've been saying is we're talking about the supply-demand curve, if you will, on natural gas. We know that we're awash in supply. We know there's going to be more demand coming because the energy grid can't handle all the demand that's going to be placed on it from these new data centers that are being built. The administration is against solar and wind power. That leaves natural gas. And gotten to the point where I thought maybe the sellers were exhausted. That happens from time to time. Every single one of these bounces got sold into. We've been hearing buy the dip, buy the dip, buy the dip. This is the opposite. This is sell the rips. So every time natural gas went up, it got sold into. And then we based here for a while. I thought, well, maybe we're at a point where the sellers are exhausted and the path of least resistance would be to the upside. We did get a bounce. And the fact that this one got sold into, when we got up here, we thought, okay, let's just go ahead and take our gains now. And man, that was great timing getting out, because obviously the sellers aren't fully exhausted yet. They're still selling the rips, but we did manage to sneak in a bullish trade there on natural gas. And then you look at USO, we had a strangle on this in our volatility portfolio because another great triangle. One of the 4 portfolios that I talked about that we picked from for Top Shot, and we got a nice breakout. We closed that out yesterday for a nice gain on this strangle. Kind of how I made my name, claim to fame, if you will, in the world of options, is creating a unique way of placing strangles where you get the best delta gamma relationship acceleration on a breakout from one of these triangles. So that was a good example of it. It worked out well. AI has a target. There's only a 42% chance that we'd come down here, but we did. And now, does that hold? We're a little bit oversold on oil, or we could very likely come all the way down here. But at any point in time, there's the risk that OPEC is going to say, hey, we don't want oil to go down too far, so we're going to decrease production. The opposite of what they did on these 2 spikes where they increased production. So we had a nice gain. we decided to go ahead and take it rather than wait and see if we were going to move down this far. And having the AI target right here also helped to give us the mode to take those gains and move on. So that's what's happening in energy. Now let's get to the Wild West right now, which is in the crypto space. You probably saw the headlines about the massive seizure of crypto from what they called a criminal organization. And then the question became, are they going to liquidate the Bitcoin, or are they going to place the Bitcoin in that new strategic reserve that President Trump created? It seems that from most places, and I don't know that we know for a fact one way or the other, that liquidation did occur across the crypto space, basically. And it, kind of plays into that. We had this big vertical rally here on the BITB, one of the ETFs for Bitcoin. I like the ETFs because you can trade options, so you get better leverage than just buying partial coins of Bitcoin itself. But what goes vertically up oftentimes comes vertically back down, and that's what happened. And now we came down to test that 60 level on BITB for the third time, and we've broken below that. Oftentimes, the third time, that was my mentor told me, was one of his rules, third time's a charm. In other words, when you test a support or resistance level for the third time, what happens then is likely to continue for the short to intermediate term, which means maybe we're not done going down in Bitcoin just yet. We are oversold. You can see how far away we are from the 10-day moving average, but we need to get back above 60 on BITB, and I would argue back above the 10-day moving average before you start thinking maybe this liquidation event is over. And the way the crypto exchanges work is kind of wild, where they can take advantage of liquidating accounts for those trading on different kinds of leverage rather than options, which have a fixed amount of risk in them. Other leveraged type of strategies don't. So looking at Ethereum, it has performed a little bit better, still moving down. But we're right here at 27.5, which is an area of support with the line. And we're a little bit oversold there as well. If we break below this, then perhaps we're coming down to 25 on Ethereum. So maybe a little more to go to the downside in the crypto space. And I would maintain a slight bearish stance on it unless we bounce off these support levels on BITB, get back above 60 here on Ethereum, back above the 10. See, the 10 to 50-day moving averages happen to be at the exact same spot. So basically on the ETHW, you want to be back above 30 before you could really feel a little more comfortable about being long. So maybe we need to let the crypto stuff play out a little bit longer. A lot of the altcoins got wiped out, et cetera. There was a mess over the weekend regarding all that was going on in crypto space and throughout this week as well. So let's take a look at some of the rest of the U.S. markets. The DIA, these charts are all going to look pretty similar. The DIA, you could argue, performed a little bit better than the SPY. Yes, it came down. Yes, it had an ugly Friday. Pretty much everything did last week. And then this week we've consolidated a bit here. Is this wave 5 finished? We're in the top end of the tap box here. It stands for time and price projection. So maybe that was a short-term high. But the wave 5 didn't extend past 100%. And when that ends, then you retrace back to the previous 4. So unless we relabel this to a wave 3 to match the S&P, boy, that's calling for a significant downward move in the Dow. Maybe that happens. That would really take something unexpected, I think, to occur. So if we are able to turn and move back up in the markets, maybe that moves back to a wave 3. We'll have to wait and see. But if we continue lower and do break the 50-day moving average, then 450 would be the next level of support on the DIA. But, we will see how the next couple of trading days go with that Fed change in liquidity, et cetera. Then we look at the Qs. They've held in there pretty well also. As a reminder, the Qs are in a wave 3, just like the SPY. The DIA in that wave 5, but does again at relabel. We're holding well above the 50-day moving average here. So yes, all the big tech stuff got hurt, but not as bad as most areas of the market did. Then we move to the IWM. This is another one that's in a wave 5. So we have the Dow and the IWM in a wave 5, and we have the SPY and the Qs in a wave 3. But you can see the IWM here has held in pretty well also. And the thought process might be, oh, these are small caps. These are viewed as higher risk. We get a little bit of a spike up in the VIX. The markets move down. The IWM is going to get crushed. But what's holding the bid in the IWM, as I've mentioned numerous times over the months, is that the IWM is the most susceptible to interest rates. And with interest rates going down, going to kind of keep a bid there in the IWM. So it doesn't mean we can't go a little bit lower. Doesn't mean we can't test the 50-day moving average. But I don't think you see a big collapse yet on the IWM. Again, as long as rates continue to move to the downside, I think that helps keep support there on the Russell. And talking about the Russell, we talk about that a lot each and every week. I've been talking about this over the last few weeks during Trade Finder. And if you're not familiar with what Trade Finder is, it's a live show that we do every Tuesday at 1 p.m. Eastern Time. We look at the markets. We look for trade ideas. We have a live Q&A. It's a great community. It's my favorite event to do each and every week because you guys ask great questions. You can interact with each other in the chat window. And so you can sign up for it with the link on your screen or going to ewotrader.com. Again, a free event that we do each and every week. Love to have you join us for this week's Trade Finder. All right, let's move to some stocks of interest here. Pretty much the same old ones. We'll go to NVIDIA, hanging in there above the 50-day moving average here. We did move up enough to label a wave 5 high there, and back down we came with what happened last Friday, and then pretty decent consolidation through NVIDIA this week. And we'll look to see if that 50-day moving average can hold. Right now, if you're looking to go long, let it get back above the 10-day moving average, and then an aggressive trade would be to trade it up. It's hard to imagine NVIDIA getting this high and not hitting that $200 level. That seems to be well in play. But we got to prove that we can get back above the 10-day moving average with some follow-through first. A more conservative play would be, let's see if NVIDIA can break 200. If it can, you can see where the wave 5 target is way up there. Maybe a renewed bid comes back into NVIDIA as we rotate around the big tech stocks. But for now, holding in there okay on NVIDIA. Amazon has been struggling a bit. We do have a qualified zigzag pattern to the downside. I'm going to jump back to the SPY real quick and talk about the difference between qualified and confirmed. This is a qualified upward zigzag in the SPY, but to become confirmed, we have to break the A wave high. So it's qualified. It means you pay attention to it. This could happen, but in order for it to actually be confirmed and then therefore likely to happen, you have to take out the A wave high. So if we go back and look at Amazon, we have a qualified, and since we've broken that A wave low, a confirmed zigzag to the downside. It's a very well formed. I like symmetry in both Elliott Wave patterns and the zigzags. And since we've broken that A wave, it looks like maybe we might creep down at least to the previous 4, if not all the way down here to this 100% extension, a little bit lower than that on Amazon, which I know is a little surprising as we're starting to move into the holiday season. You think this would be a really great time for retailers in general, specifically Amazon being the king of all retailers. But there's been a lot of talk about maybe this isn't going to be that strong of a holiday season. I wouldn't bet against the U.S. consumer. We find a way to spend no matter what's going on, but there are some concerns about it, and I think that's weighing on Amazon. I don't think anything really bad or nefarious is going on here. Maybe just a pretty healthy move down here in this zigzag, then perhaps we turn and move back to the upside. Apple, we moved down on that Friday. It did label a wave 4, but it's green, meaning that the algorithm is not sure that that wave 4 is complete yet. We didn't quite make it down to the 50-day moving average, and we're only roughly around the 23% fib retracement, which Elliott himself would write that he didn't have a whole lot of faith in. He liked a corrective move to get more to the 38 level to feel like it was indeed a correction and have a point to potentially bounce. Apple got its move. People were dying to get into Apple. They had the meeting with Tim Cook and President Trump. And then the new iPhone 17 came out. Same thing I've talked about over and over again. Their innovation is just really not there anymore. But it did give enough for people to come in and notice how this zigzag pattern exactly agreed with the AI target here. both of them the same spot, which is exactly where Apple went for a couple of weeks. Then we've ticked down a little bit. Can we hold above this A wave high is what I'll be looking for, which coincides pretty closely with the 50-day moving average. Then you look at Netflix, just been a pretty decent consolidation, really, through this big run that it had off the April lows. And if maybe we're going to have a weakening consumer a bit, maybe everybody's going to stay home, staycations, maybe there won't be a lot of travel this holiday season, people will be watching Netflix. We'll see. We had this symmetrical triangle, had a bit of a breakout here, went up and tested it. We're coming back down. One of the three ways that triangles can break out. And one, they just take off and run. Another one is they come back, test the breakout here, and then continue in that downward move. And the third way is that the first initial move is a false breakout, and then the big move is the other way. But with this part of the move right here that's occurred this week, seems more likely that that was a breakout test and perhaps maybe heading a little bit lower in this wave 5. We could get down to around 1100 or so on Netflix seems to be a likely scenario there. One that I keeping an eye on, keep watching. It's on my watch list every day, SMCI, because I do feel like as we move into the period of time of performance chasing, and that's when you have institutional managers that have underperformed. All their big money is from bonuses. They get bonuses at the end of the year if they beat the S&P. Yeah, they're well paid in their salaries, but the big money is from bonuses. But they don't get it unless they outperform the SPY or the S&P. And so what tends to happen this time of the year, and there's a lot of them by the data that you read of institutions that have underperformed the S&P, they're going to be looking for where are the best ways. Can I get the best bang for my buck into the end of the year and try to get my performance above the S&P. So stocks like SMCI, which haven't participated as much in the big tech run, they had all their accounting issues, et cetera. That seems to have calmed down. We had a little bit of a bounce. The only negative here is the fact that we do have, at least at this point, lower high there. So if you're watching this, the first step would be to be above 55. And a more conservative entry. I like to give both aggressive and conservative entries. We all have risk tolerances. You know what yours are. But a more conservative entry would be if we broke that trend line. Then I think maybe we could get another run in SMCI. And I think that institutions would be interested in that. AMD, they gapped up from their big deal that they got. It seems like OpenAI, if you form a deal with them, your stock gets rewarded. AMD was one of those. We had the big gap up. We consolidated here for about a week. Had another tick up yesterday, a little bit above the 10-day moving average on the high. There is a target price up here around 275. The AI is not sure about 12% chance that it makes it up there, but perhaps it does. And part of that's because it's had such a big run already. More consolidation here, backing and filling. It's allowing the 10-day moving average to catch up. That's healthy. A few down days wouldn't even be that bad, but perhaps there could be some more upside to go in AMD, but it is going to need the market to cooperate and move higher and interest rates to continue down, the Fed liquidity becoming injected back into the system away from the Treasury, which is what they did. They shored up the Treasury. That's been satisfied, according to what Chairman said as well. And talking about Alibaba, this has been interesting because back in this area, I was thinking that China's a good place to be. They've been underperforming, and we had this nice rally right up here to the AI target. And then that optic came out of President Putin and President Xi of China being all chummy. I didn't think that was going to sit well with the administration. I thought maybe we would get some of this negative tariff stuff that we've been having recently a lot sooner. And it didn't happen, and everything China, including Alibaba, went running to the upside, and then we got it last Friday. So I was right that that was going to be upsetting to the administration, and we'd probably see some more tariff, posturing, if you'll call it that. So I ended up being right, just wrong on the timing. I thought it would have been back in here, but finally it came back down. Again, as I said in the beginning of this broadcast, nobody believes this is going to last forever. Maybe it goes on for a while, but it doesn't behoove either the U.S. or China to be at a trade war with each other because we need each other And now we've got a wave 4 that's formed here right at the 38.2% fib level. So perhaps that's the corrective move that we got from the tariff chatter. And then maybe we go back to the upside. And I just wanted to finish by talking about how I'd been opining on what could cause the market to go down, what could create this spike up in the VIX. And that was not one of the scenarios that I was talking about. I thought the Fed might disappoint, et cetera. And turns out just we made a about face all the way to the tariff stuff is what created it. But let's finish off with the banking sector, because the financials were reported this week, and it's been a tale of the haves and have-nots. The big banks have performed pretty well. The regional banks, not so good. And there's been some that are saying that there's a record number of loan defaults on auto loans, and the big banks are saying no, their auto loans are fine. So there's some speculation that maybe some of the regional banks that provide funding to lower income consumers, et cetera, may have relaxed their lending standards a little bit too much, et cetera. But the regional banks have not been performing well. We are at a 50% corrective move here in the wave 4. So maybe that's all we get. We're a little oversold from the 10-day moving average, but I'd keep an eye here for the health of the consumer. I think that'll give us an idea of what the holiday season could be if we can bounce here and start and turn back to the upside. But again, big banks performing well, regional banks not so well. Thanks as always for watching, and have a great weekend. Look forward to talking again soon. Take care, everybody.